Warning, if you are managing less than $1 million and you are copying super investors like Warren Buffett for your investment ideas, chances are you are making 3 mistakes. In this video, I'll explain you what they are and how you can avoid them. So, let's dive in! Looking at the investment made by the super investors is a great way to find your next investment ideas. However, just because something works for Warren Buffett and other great investors doesn't mean it's okay for you. If you want to copy their investment that aligns with your goal, your focus, and your time, as opposed to their goal, their focus, and their time, you need to avoid those 3 mistakes before making a decision. If you are managing less than $1 million and your goal is to make your money work aggressively for you, investing in big companies like Apple might not be the best place to focus. According to Peter Lynch, who was one of the best investors in the world, over the long term, a stock's price follows the earnings of a company. This means that if a company doubles its earnings in the next 5 years, its stock price is also likely to double. For a company the size of Apple, it will take them more time to double in size than a fast-growing medium-sized company. One of the key factors that can slow down their growth is the saturation of the market for some of their best-selling products. The smartphone, a major revenue source for Apple, might face slower growth because of the maturity of its market, leading to saturation. Your logical question might then be, why is Apple the biggest US stock position of Buffett if it might take them more time to grow than a fast-growing medium-sized company? The reason is that he has too much money to invest, which prevents him to putting his dollars into medium-sized companies. Warren Buffett is in a season of his investment journey where most of the US-listed companies won't move the needle in his portfolio if he decides to invest in them. As of December 2023, the size of his portfolio is $350 billion and he's sitting on a cash pile of $170 billion to invest. If he invests $5 billion in a mid-sized company and his investment doubled to $10 billion, the $5 billion gain represents 1% of his portfolio size and the cash he's sitting on. Buffett discussed this issue in his latest 2023 shareholders letter. This combination of the 2 necessities I've described for acquiring businesses has for long been our goal in purchases, and for a while we had an abundance of candidates to evaluate. If I missed one, and I missed plenty, another always came along. Those days are long behind us. Size did us in, though increased competition for purchases was also a factor. The size issue affects its performance, and Buffett has spoken about it in the past, mentioning that if he were working with a smaller sum of money, he could be making a 50% return per year.
True. I think I can name a half a dozen people that I think could compound $1 million, or at least they could earn 50% a year on $1 million, have that as an expectation, if they needed it. I mean, they'd have to get their full attention to be working on the sum. And those people could not compound money, 100 million or $1 billion, at anything remotely like that rate. I mean, there are little tiny areas which, if you follow what I said on the screen there on that Adam Smith's interview a few years ago, if you start with A and you go through and you look at everything and you find small securities in your area of competence that you can understand the business, I think you could, and occasionally find little arbitrage situations or little wrinkles here and there in the market. I think working with a very small sum, that there is an opportunity to earn very high returns, but that advantage disappears very rapidly as the money compounds.
If you're managing less than $1 million, you are not in the same situation as Buffett is. You can invest in smaller companies that can produce higher returns for you. Mid-sized companies, thanks to their smaller size, often have higher growth rates compared to larger companies simply because they are starting from a smaller base. When a company is smaller, even small or modest increases in profit can translate into large growth percentages. This is in contrast to larger companies which already have big numbers in terms of customers, revenue, market share, and profits. For them, achieving the same percentage growth can be more challenging because they are starting from a larger base. A mid-sized company making $1 million only needs a $1 million profit improvement to double its profits. For a big company earning $1 billion, doubling its profits means a $1 billion profit improvement. If those mid-sized companies offer either growth potential and you're managing a smaller amount of money than Buffett, it makes sense for you to focus on them. Many people believe that looking at great investors' smallest positions is not worth their time. If we look at Warren Buffett's portfolio's smallest positions, some of them are medium-sized companies. Your logical question might be, why is he buying those medium-sized companies if they won't impact his overall portfolio? I don't know Buffett personally, so it can be difficult to get a response from him, but I've come up with 2 assumptions that can answer this question. Assumption number 1, those investments were made by Ted Weschler and Todd Combs, 2 investment partners who manage around $30 billion for Buffett, as stated in Buffett's 2021 shareholders letter. Assumption number 2, Buffett invested in them because he believes that they have the potential to grow into very large companies quickly. Both assumptions indicate that those medium-sized companies are wonderful and should get your full attention. If assumption number 1 is correct, those companies, even if they are medium-sized, represent a larger portion of the money managed by Ted and Todd compared to Buffett's overall portfolio. If assumption number 2 is correct, it could mean that these companies are so exceptional that even if Buffett doesn't expect them to significantly impact his portfolio in the short term, he still chooses to invest in them, anticipating massive future growth. If you are managing less than $1 million and want your money work aggressively for you, focusing on this type of investment is your best bet when copying Warren Buffett and other great investors' portfolios. If you are only focused on copying their big positions, you might be making an oversight by neglecting those medium-sized companies. In addition of making this mistake, you are also making it harder to find good investment opportunities by competing against investors that are better than you. When you are focused on copying Buffett's big positions, you are competing against many other skilled investors. This is because other great investors managing a large sum of money will also face the same challenges as Buffett and will focus on those big positions. Monish Pabrai has spoken about this issue in a recent interview.
The other thing about investing to keep in mind is that when someone is a really good investor and they have small amounts of capital that they're working with, let's say someone is an exceptional investor, they have $5 million that they have under management. Their universe is very large. They can invest in almost anything because they could make, $500,000 bets or something. As the world finds out about them and the 5 million under management goes to 5 billion, for example, they can no longer make $500,000 bets. So they have to move up the food chain, if you will. And when they move up the food chain, the bottom of the food chain gets emptied out, which means that that space becomes available to new entrants who can only make $500,000 bets. So the nature of investing is that the very smart brain power that is initially at work at very small nooks and crannies of the market, by definition, that brain power will move away from those nooks and crannies because they'll get successful and they'll move into larger, greener pastures, larger pastures. So value investing has this kind of notion where continuously the bottom is being emptied out for the next generation to come in. So for all of you, if you have small amounts of capital at your disposal, you have a huge advantage.
My question for you is, if you are managing less than $1 million, why would you create a problem for yourself by not taking advantages of this opportunity? Let me know your response in the comment section. This is it for today, guys. If you got value from this video, feel free to drop a like. And if you want to receive more content like this, feel free to subscribe. Thank you all and peace out.